Good morning, everyone. I'm Richard Kalordi, the Marketing Manager for HLB Man Judd in Perth. And today we have the first in our Financial Planning Tips for the Next Generation series presented by Lauren Lockhart, who is a Certified Financial Planner at HLB Wealth, the Wealth Management Division at HLB Man Judd. As corporate representatives of Paragem, Lauren and the HLB Wealth team work closely with clients on a number of investment strategies. And today, Lauren will look at buying your own home, government stimulus packages available, what you should spend, and whether accessing super is a good option for you. I also need to advise listeners that the information contained within this webinar is general information only and does not take into account your financial position, objectives, and needs. You should also consider its appropriateness and seek financial advice before making any financial decisions. Also, if you have any questions at all during the webinar, please send them through via the Q&A box at the bottom of your screen, and we'll go through these towards the end of the session. Lauren Lockhart, thanks for your time this morning.
Hi, Richard. Thanks for having me.
I'd like to start with buying your own home. When do you think is the right time to buy your first home?
Yeah, so there's no right or wrong time to buy your first home. I think it's more about when it feels like it's the right time for you. When we talk about when, I hear of a lot of people trying to time the market in regards to things like property prices or attractive interest rates offered by the banks. And these are certainly metrics that you should be considering when you make a decision like this, but it isn't the metric upon which you should be basing your decision. The important factor is to look at when you can afford the right home for you and potentially also your family. Try not to worry about too much about what the market's doing or in particular what your peers are doing as well. As a financial planner, I like to ask the question, why? And I think asking why will help you figure out if the timing's right for you. So why do you want to purchase a home in general? And then why do you want to purchase that specific home that you're looking at? And the thing is that you need to figure out when's the right time for you. And I think in this thought process, we need to consider both financial and non-financial considerations there. So that's going to help you figure out if it's the right thing to do, and then if you're financially in a position to be able to make that happen, which of course helps us figure out if that in fact is the time that we can pull the trigger and go and buy our first home. So the non-financial items that you need to think about is really around figuring out if buying a home is the right thing for you to do. So you kind of need to think about, does buying a home suit your current lifestyle now and in the near future? Do you want the responsibility of owning and maintaining a home? Because that certainly is something that needs to be considered there. And also look at other homes that you can afford now, maybe the right and appropriate home for you that you want to invest a large sum of money into. The other things you need to consider is, does owning a home in general suit your lifestyle? Are you, say, for instance, somebody who travels a lot because of work or relocates? Maybe setting down roots with a home isn't something that's going to suit you. The financial factors that you need to consider, of course, can't be avoided, and that's the initial affordability of being able to get the home, and then also your ability to be able to get out a loan. As we know, most of us will need to use debt as an instrument to make this purchase. The other things are your ongoing ability to be able to service that loan and of course still service life. So we need to keep living despite the fact that we've bought a new home. You need to think about things like, do you plan on staying in this home for the longer term? Because there are significant amount of costs when you look to enter into the property market. And the longer that you're in a particular home or in that property, the more years that cost is spread across. So if you find you're going to be someone who's up and moving every 2 years, maybe these outlays of initial costs is going to make this exercise a really financially impactful journey for you. So ultimately it comes down to, are you able to buy the kind of home that you want? and can you pull the trigger and do that. So maybe that might help you figure out if it's the right time for you. But if it's not, I think going through this exercise will help you see where maybe there's some things that need to change in that journey. So for instance, do you maybe need to get to a point in life where you're able to set down some grassroots, or is it maybe that you need to get your finances in a better position, and then that will tell you, more likely tell you when you can do something like that.
Right. Okay. So buying your first home is obviously quite a process. What do you think is the first step that a young person should take when buying their first home?
Yeah, all right. So I think the very first step that someone should take before you even have the temptation of going on realestate.com and trying to find your dream home is going to speak to a bank or a lender, because it's really important to get advice before you get out there into the market. A lender will provide you with something that's called a pre-approval document. So this is basically an estimation around the borrowing capacity based on your current financial situation. And it's vitally important for those who want to purchase a property with some debt. The other reasons it's really important to speak to a bank is because you want to know how you're going to get assessed on a loan application well before you get to that process. And the thing is that the bank's looking at everybody differently. I guess no single person is the same as somebody else. The things that the bank are going to look at are things like, are you buying that property alone, or are you buying it jointly? Are you a double income or a single income household? Are there financial dependents that you need to consider in this factor? So things like children. Other things are, how long have you been with your current employer, your employment history? How does that look to the bank? If you're self-employed, there tends to be maybe a little bit more of a process when going for a loan. So try and get those things sorted up front, because when we get to putting an offer on and then getting that finance through, we don't have a finite amount of time. So we do need to get that moving quite quickly. The other things are, you want to know how your existing debt or your financial position to date is going to impact your application. Ultimately, you want to know how attractive you're going to be as a loan applicant before you go out and find that property. And it's really important because knowing how much you can lend and forms the basis of how much you can borrow, therefore how much you can actually spend on a property. So it gives you a guide of what you should be looking for when you're out there in the market. The second thing is it gives you a guide if the bank thinks that you're desirable, and some parameters around what they think that you can afford as a homeowner. And lastly, and probably most importantly, it gives you that benefit of some upfront information. So it's going to let you know if maybe the outcome's not desirable at this point in time. You're not going to go out and find a property you fall in love with to, I guess, be heartbroken that the process isn't going to work out for you this time. And again, the bank will give you some metrics around what you can do to be a better loan applicant, so you can work towards that if this is your goal. The other thing is that on the flip side, it's going to provide you with a lot of confidence if you're going out into the market. So you know you can make offers and work with properties that you're going to achieve a successful outcome. When you have this pre-approval document, you can also submit that with your offer. And it shows a lot of seriousness from yourself as the buyer to the person that's looking to accept an offer on your behalf. There is an important thing to note, that a pre-approval will not guarantee that you'll actually get the loan, but it's sort of the next best thing that you can do when going out there and preparing for your purchase.
Right. Okay. So let's say the bank gives you a range that you can borrow and that they're willing to loan you. How do you work out what's the ideal amount for your first home?
Yeah, so the bank giving you the range is a great starting point. And then the ideal amount is obviously going to be very specific to each person's unique circumstances and what they want in a home. But I think the ideal amount for you comes down to a few main things. That's, are you buying a property that's going to suit you for the medium to the long term? Can you meet the deposit requirements of the amount you want to spend, plus any purchase costs associated with buying a home in that property range? And lastly, can you service the associated repayments plus the associated costs of that property, and then still live as you wish. Because when we're buying a home, we're doing it to improve our livelihood. So we don't want to financially devastate ourselves from getting a home. So we've spoken, I guess, a little bit up to this point about finding a property that's suitable for you for the longer term. But really what you're trying to figure out there is the dollar value, that your ideal amount, going to give you what you want from a property? I guess we need to make sure that that amount is actually going to achieve what you want from a home. Secondly, looking at the deposit requirements. The banks will generally give you a savings goal of about 20% when looking to purchase a home. So for instance, if we're looking at a $400,000 home, that's an $80,000 deposit to be 20%. Now that is a pretty big number, particularly when you're a young person trying to enter into the property market. And there are options if you don't have that 20% deposit range, but of course that will come with a few caveats when you're looking to apply for a loan. I personally like a savings goal of 20%. It's going to show the lender and yourself that you have the capacity and ability to put money aside and save up some genuine savings. And then obviously that's going to assist you in your ability to service a loan for the longer term. The last thing that we look at is your ability to service that loan in terms of repayments, the new ongoing costs of having a property. So I think maybe this is something that's forgotten about when we budget pre-home and post-home. So once you have a home, there's certainly some additional costs associated with that. So we're talking things like rates, insurance to protect that home that you have a lot of debt out on, service charges, maintenance of the home. There could be a vast array of things that now will form part of your expenses because you have that home. And then of course, we want to make sure that you're still able to live. So when I guess thinking about that situation, you want to make sure your family's after-tax income is sufficient to support the repayment, an estimated amount of that new cost to you in being a homeowner, and then make sure that you obviously have some money left over for you to live. What's very important, I guess, in this equation here when trying to find your ideal amount is to make sure that you have a buffer above your minimum repayment amount. Now, it's important, firstly, when the bank's giving you a 30-year loan, if you want to try and get that down in less than 30 years, you're going to have to put a little bit more into your repayment to make that happen. But secondly, so we have a buffer of interest rates rise, and interest rates change all the time. At the moment, we're obviously in a situation where we have quite low interest rates, that they can change. They can certainly go up or down, and you need to make sure that you have a buffer, because if these go up, you want to be able to support that and not put yourself into financial duress. So when thinking about how much you should spend, you need to factor in your ability to afford that initial cost and then afford those ongoing costs. I guess to work out what that number looks like, and if that number that you can comfortably service can achieve what you want from a home, so it gives you a property price that gets you what you want, then I think you've figured out your ideal number and you can probably go for it. And if these factors don't align, so for instance, your financial situation isn't going to be able to give you a property that's suitable, then maybe you need to go back and have a look at what we can do to make that equation work. So that might be that we need to save a little bit more to get in to enter where we'd like to in the property market, or we could maybe compromise a little bit on what we want from a home and see how that sits with you and your family.
Right. Okay. So if somebody, what are some of the considerations or conditions to think about if you do not have a 20% deposit?
Yeah, and then this is certainly something that is quite common with property prices being relatively high compared to our incomes. But I guess firstly, just remember, the smaller the deposit you have, the bigger the loan's going to be. So I guess in essence, that's more interest that you're getting paid on, potentially longer that's going to take you to pay off the loan. But more specifically, what I'm talking around the 20% is where a loan applicant has less than a 20% deposit. They may need to get what's called lender's mortgage insurance, or it's known as LMI for short. Basically, what lender's mortgage insurance is, it protects the creditor in the case that the borrower cannot meet their repayments. So there is a little bit, I guess, confusion around what this insurance is. I find there's a bit of a misconception that sometimes this insurance protects the borrower, when in fact it's actually just protecting the bank. So it's protecting the bank for taking out a loan on somebody who doesn't have that level of deposit to service the loan. Generally, it's a one-off fee charged to clients, and this can be added to your loan or you can pay it outright. But remember, where this fee would be added to your loan, again, that's more interest and potentially a longer period that it'll take you to pay off. The average LMI based on current statistics is about $6,200, but it can be more the smaller the deposit you try to enter into the market. So it is quite a significant cost to a first home owner. I guess really with not a great deal of benefit other than that, it allows you to get that loan and move into the market. The alternative option is what's called a guarantor loan. So this is where a family member or a friend who owns their own home will sign as guarantor, allowing you to use the equity in their home as an added security for your loan. So meaning that they will be liable for the loan in the event that the loan applicant's unable to meet repayments. So if you have a guarantor and you don't quite have that 20% deposit, you won't need to pay LMI. So it is a significant saving for a new homeowner to avoid that one-off cost. But I do like to caution people when we look at something like this, because it can restrict the person who is going as guarantor for you from things that they maybe want to do financially. And in the same hand, it's one of those things that has a bit of a relationship impact, and just to be mindful on how that might impact you personally. Yeah.
Okay, so let's talk about the, there's a number of government stimulus packages at the moment around home ownership due to COVID-19. Are these packages, what's your view on them? Are they making home ownership more attractive?
Yeah, so this is probably undoubtedly something that's on everyone's mind at the moment, certainly spoken about quite a lot. And if the attendees today, like me, have social media, I feel like it's just pitched at you all the time. So I think people naturally love a good deal, and we're sort of drawn to things that offer us savings or freebies and stuff like that. I think sometimes we might enter it without a clear head. And when reviewing the current federal and state announcements, I guess that certainly fits the purpose. So just to preface for our attendees, we're in WA, so I'm going to be using the WA state packages as well as obviously the federal packages, and then I'm also going to be talking about the WA state stamp duty charges. So these do differ across the states. So I'm going to break it down into pre-COVID and post-COVID packages. So these pre-COVID packages are still in place. The first one we have on offer is the first homeowners concessional rate of stamp duty. So this is where there is no stamp duty applicable for a first homeowner up to $430,000, and then a concessional rate applied up until $530,000. So to give you an example, if someone were to purchase a property worth $450,000, a first homeowner would look to pay about $3,800 in stamp duty. And then a non-first homeowner would be looking at more $15,500. So it's about $11,500 saving that offered to first homeowners in terms of stamp duty. So it is pretty significant, and this is something that's offered for those who build and who buy established. The other offer that's in place pre-COVID is the $10,000 first home owners grant. So this is something that's been around for quite a while, and it's obviously a $10,000 payment for those who buy or build a new property. So unfortunately, this isn't available for those who are looking to buy established. I guess in essence, it's always been the government's way to try and promote building, because obviously building promotes the residential market, and we're talking about the construction industry. So it's promoting jobs, which is something that's always on the government's agenda in terms of the economic effects. So since COVID, we've had some more recent announcements that have given a few more grants available to those who are looking for new builds or significant improvements to a home. And along with these announcements, when you read on the website, it does specifically say that they are in place to promote WA residential market and stimulate jobs in the construction industry. And I think it's really important to keep that in mind. These grants are available because we need to help the economy, and a big part of that is to get more jobs out there, more jobs to people who need them. So while the government incentives might seem very attractive, they are aimed for you as a first homeowner to go out, spend money and build a property. So I think you really need to come back to making sure that you review that. Is this the right thing for you on a personal level? So the two new grants that are available are the Home Builder Grant, which is a $25,000 payment. This is a federal offering, so it is Australia-wide for those who want to build a new home or make a significant improvement to a home. And there are some parameters around if you're eligible for that. Then there's also a new state grant, which is a $20,000 WA building bonus grant. So that again is another lump sum payment if you are looking to build a new home. So this is how we get to $55,000 worth of grants available to first homeowners who are looking to build. And it is a massive amount of money that we're looking on offer if you wanted to do something like that. But in my opinion, I'd like to see individuals looking at making sure that building a home was right for them, that it offered them all the things that they wanted in a home in terms of location. Obviously, there's a period where it'll take you some time to move into that home. So just making sure that everything's right for them. And if that's the case, then absolutely go and get your $55,000. It's really just gravy for you. But I think my fear, I guess, is that we'll have a lot of young people rushing into the market to gain benefit of these grants. And it might seem a little bit counterintuitive if you're going to jump before you're ready and you have additional things happen like LMI costs, or that you perhaps are going to put yourself under financial stress to do something like this. So I think it comes back to, is it the right time for you to be in the market? And is this something that you want? And then take advantage of those grants. I would offer a word of caution. All individuals should be looking at what's available to them from the government when you're looking to purchase a first home. That's why we have these incentives here to help young people get into the market. But it's vitally important to make sure that you are eligible for these before going off and spending it mentally in your head. So the last thing you'd want to see is taking a jump like this and then finding perhaps that an application is declined. So do your due diligence, go out there and make sure that you're accepted before you take the leap and look to use these government stimulus packages.
Right. Okay. So another post-COVID government stimulus is access to superannuation. Do you think that first home buyers should access their super to fund their deposit or even pay down part of their loan? What are your views on that?
Yeah, this is a very popular question since the early release of super was introduced, and it is still available for those eligible individuals until the end of 2020. So it is something that we're still talking about. And I guess in reality, it's a bit of a catch 2022, because who really thought that we would be talking about you being able to access your super? I guess traditionally before this point, super was used for your retirement savings, and there was just no way you were going to be able to touch it until you reach retirement or until you reach what we call a condition of release. But I guess like everything, I like to put it into context. So if we look at it, the economy's been hurt, obviously, by the recent COVID-19 situation around the world. And if you look at the ASX 200, which is the top 200 companies in Australia, it saw about an 11% dip last financial year. So I think a lot of young people think that the stock market doesn't really affect them personally, but it in fact does, because our super system makes up ownership of a lot of the companies out there that are listed and both unlisted. So we do have a bit of skin in the game from that point of view. I guess my point is, in order to give you that $10,000 that you're chasing, your super fund's going to have to sell down on your assets, unless, of course, you are already in cash, in which case you've got the cash sitting there ready. So basically what it's going to mean is that you might be realizing some losses in your super fund by selling at that point in time. So I guess history shows us that if we ride the ups and downs of the market, then we end up in that smooth transition up over the longer term. But if we're trying to pick and we pull out and cash out when things get low, then we realize losses and potentially don't have the ability to benefit of the uptick when that event inevitably comes. My next point is super is a tax advantageous environment. So your earnings in super are taxed at 15%. And this is generally a little bit more attractive than the marginal tax rate, so the individual tax rates that you pay as a taxpayer. So it's generally more concessional than your middle and your high income earners. So consider that it's a pretty advantageous location to put your money to have it grow and then pay a little bit less tax on it. Now, please remember that this is different from using the super to survive. That's a different scenario. Here we're talking about using it for a home deposit or using it to pay down your home loan. And that's something I'm hearing a lot. I'm taking it, but I'm using it to pay down my home loan. So I'm not just throwing the money on things, lifestyle expenses, I guess. And I guess let's put it in context again. If you're going to take that $10,000 out of super and put it on your home loan, if you've got an interest rate of about 3%, you're saving about $300 a year in interest charges, which is great. However, if you left that $10,000 in super and continued to have it invested, you would need to earn 3.53%, less obviously the tax that you're going to pay on earnings, to make that same $300. So I guess the question is, do you think that your super fund is going to be able to return more than 3.53%, which again is possible? Then maybe you're a little bit worse off taking your money out of super. The other option you mentioned, Richard, is using that $10,000 as a home loan deposit. Again, the concept's quite similar in terms of the financial savings that you're going to get by putting it, obviously using it as a deposit, and that's less you need to lend and therefore less you need to pay interest on. But I would offer some caution to individuals out there that just check with your bank about how they're going to assess that $10,000. So generally when we're talking about saving up a deposit for a home, they like it to be what's called genuine savings. So it's something that you have saved for and you've, I guess, allocated your expenses accordingly to be able to achieve that level of savings. The banks might not allow you to include that as your deposit if it's not classified as genuine savings, because we just took it out of super. So again, just make sure you're considering that before you go guns blazing to the bank and letting them know you found that last $10,000. Just make sure that they're going to honour that that's something that you can in fact use as part of your loan application. But for me, I guess it all comes back to what the purpose of super is for, and that is to save for your retirement savings. So I guess I'm personally a little bit loath to take money from your future self to benefit your current self. But again, you've got to look at, is it the right financial decision for you? And then I guess make that decision according to what's best for you.
Right. Okay. So when someone is buying a first home, are there additional factors that they should consider if they are in a couple situation or if they are a single person? Could you elaborate a little bit on those scenarios?
Yeah, I guess one big thing that comes to mind, a decision that you need to be making upfront that I think maybe gets a little bit lost in the excitement of buying a first home, is how you actually own that home. So there's two different ways that a couple could own a property. That's firstly joint tenancy, or secondly what's called tenants in common. So joint tenancy is the more common type of ownership, at least in WA, when dealing with a de facto type relationship. So this means that you own the home together, and in the event of either one of your deaths, the asset automatically reverts to the surviving spouse. So if that was your intention, that you and your partner own a home together and what's mine is yours and yours is mine, we say, right? Yeah, so then you're obviously going to know that upon your death, that asset automatically flicks over to the surviving spouse, and that's how it's handled. The alternative is what's called tenants in common. And this is where each individual will own a portion of the home in their own right. And upon their death, their portion of that asset will form part of their estate and then be administered as per their will if that's something that they have in place. So with this type of ownership, you can have different splits of percentages. So say if you wanted to have a 60-40 split or another alternative to that, but you can also have a 50-50 split if that's what's right for you. When considering buying your home, I always tell clients to consider their estate planning as well, because it's something that I guess you want to be aware of when you're making this choice. Tenants in common is something that I see quite common with people who are maybe like second time rounders or in a second relationship, because particularly at this point in time, you'll find a lot of your overall wealth is held up in your home. So if you have children to a prior relationship and you now have a new de facto partner, by having joint tenancy, pretty much all of your wealth is going to go to your de facto partner. And if you have nothing left in your estate, potentially your children might miss out. So having a tenants in common arrangement might allow for your half to go into your estate and then be split amongst your de facto partner and your children. So it allows you a little bit more flexibility because obviously the joint tenancy arrangement, unfortunately, that money will go directly to your spouse, whether that was or wasn't what you wanted to do. So just a bit of a consideration there. If you're looking to buy a property solo, I guess generally you might just have that in your own name. But something that you do need to consider is what happens to that property if something happens to you. So say, for instance, if you have an accident, and you are unable to make financial decisions. We call that in our world incapacitated. So you're unable to make a decision on your own behalf. This could, for instance, mean that you need to maybe move into a specific assisted living location, and then your family's left to maybe sell the home to fund the new life that you're living. The legal document that you use to do something like that is called an enduring power of attorney. So this is a person that's able to make financial decisions on your behalf. And the word enduring means that it continues if you become incapacitated. So this person can make decisions for you where you can't. It's important to potentially look at having that in place, because that allows then that person to make those decisions for your property in a timely and efficient manner to help you where you're unable to make them yourself. So I guess just something that you should be considering in the what if scenarios when you're looking to buy a big, make a big expense like a property. Of course, if this unfortunate thing was to happen, it would probably get sorted somehow in the end, but from experience, it's probably going to be a little bit messy. It's not going to be very timely, and it might be a bit costly to try and have this sorted out. So it's just something that you want to consider upfront before you make a purchase. The other thing to consider is if you're, say, a person who is at risk of potentially being sued in your line of work, you might look at owning your home in a way that protects that asset, that if something were to happen, that your family home isn't up for grabs, and you've structured it right up front. So we've provisioned for all potential scenarios happening.
Right. Okay. So I know that we're talking a lot about home ownership in this webinar. What's your stance on the age-old question of rent versus buy?
Yeah, I do get this question a lot. And I think as Australians, we have like a love affair with property, and it's almost like a rite of passage that you go out, you get a job, and then you buy a home. But when talking to clients, it all just comes down to the question of what's right for you. And buying a home certainly isn't right for everybody. If we're being honest, I guess renting is a little bit annoying. You can't modify the home how you'd like. You're subject to things like rental inspections. So for some people, I know that renting is just not what they want, and that's completely fine. That's where their goal is home ownership, and they know that that's the right thing for them to be doing. But renting is certainly still a very good option for individuals, particularly if you're unsure about where you'd like to live. So you're not quite ready to make a big purchase if you don't know what location you want that to be in. Maybe you're not really at a point in your life that aligns with buying a property. So for instance, you want to travel a lot, you're not wanting to worry about a home back at home. You really want more freedom from your lifestyle. Again, you don't want to stay in a particular location for a long point of time. You want to travel or work elsewhere. Maybe a big lumpy home that you have to worry about isn't right for you. So renting could be a better option. The other thing is that some people just don't want the risks of owning a home. I mean, with any investment, it is a risk that you take out by investing all your money into something that you need to, I guess, think about, consider and maintain as part of your life moving forward. There's a bit of a misconception that where you're able to buy a home and your loan repayments are less than your rent, that you're better off buying. And I think it's a bit of a flawed and oversimplified way of looking at things, because you're not really comparing apples with apples. So when you think about your sunk or unrecoverable costs of doing something, when we're talking about a rental arrangement, that's your rent payment. So that's sort of, I guess, the money you're throwing at the wall. But when we're talking about owning your home, it's a little bit more complicated to figure out how much money you're spending on things that are unrecoverable. So there's a little bit more to it than just your loan repayment. The things that you need to look at are the costs that you're incurring as a homeowner. So these are things like your rates, your service charges, all the things we've been speaking about in this webinar. Costs of insurance. The interest that the bank charges you, again, will be one of those unrecoverable costs. And we know in your repayments, it forms the principal and an interest repayment. So the principal will be paying down your loan and the interest is what you're paying the bank to lend you that money. But one cost that's often forgotten about is your opportunity costs of using your home deposit. So say, for instance, you've saved up $100,000 that you are now going to put in as your home deposit. If you were renting, you would be able to use that $100,000 to do something else, perhaps invest in something else. So where you were able to find an investment that might return better than what your home would, there's actually an opportunity cost there that you're missing out on by using that money in now stuck in your home opposed to other investment options that are out there. And again, there's also the unrecoverable costs of initially purchasing the home, which again are those stamp duty and other costs. And so in the first instance, again, I would just encourage clients to think about what's best for them. I guess if you're somebody who wants to plant roots in a community, you know that that's where you want to be there for the long term, then maybe buying something better for you. But again, if you're somebody who doesn't know your desired location, you want to move around in the short term, say you're single and you want to buy 4, buy 2, and that just doesn't really suit you right now, then maybe renting's a better option for you until you're ready to make that leap and you find that when it's right for you to purchase a property.
Right, okay. Now, we've spent a lot of time talking about property during this webinar, and the title of this webinar is Financial Planning Tips for the Next Generation. Just in the last 5 minutes that we have left, could you elaborate a little bit on some of the other investment options that are available to the next generation aside from buying property?
Yeah, so if we're talking about property, I think owning a property is a different proposition to buying a property for investment purposes. And I do hear of a lot of people wanting to buy a property as an investment option, but there are so many different investment options out there available to young people. So I always suggest that clients think of the other things available to them other than just property. So the things that I tell people to consider when looking at the right investment for you is first to think of the entry level factor. So if we're looking at a home, it's generally a pretty expensive asset to enter into. You have the deposit requirements, and then of course you need to take out a loan to service it. So it kind of means that you can't dip your toe in the water in terms of investing. So in terms of an alternative investment, because I know we're talking about investments next week, we'll just use a portfolio of shares or managed funds as an alternative to property. So whilst other investments will have an entry level amount, they're certainly much, much less than a $400,000 property. So say, for instance, you have $10,000 and you can start a little portfolio for yourself with that. You can just keep adding to that as you go. So with a property, you'll find that you need to save up a large sum of money before you're ready to pull the trigger on doing that. But with an investment portfolio, you can start small, get comfortable, and then keep adding to it as you go. So you'll find that the entry level barrier is a lot lower in an alternative type of investment. The other thing is diversification. So as a financial planner, I'm really big on diversifying your investments because we know that diversifying investments spreads and reduces risk. So when owning a property, you're sort of owning it in a single asset class, and I guess we could call that direct property. But I guess it's kind of even more limited than that. It's Australian property in WA, in Perth, in the suburb that you chose. That's I guess your asset class of what you're buying. So you've got this really large sum of money that isn't overly diversified. When you look at a portfolio of investments, you can spread your risk off over so many asset classes. So things like cash, fixed interest, international investments, Australian investments, alternative type asset classes, lots of different things. So you have a much broader scope of investment available to you. The other thing that we can do is we can tailor those investments to your risk profile. So whether that be more aggressive or less aggressive, there's a lot more things and freedom that we have in terms of the scope of how we invest. The other thing is the ongoing income from investment. So I know people love property because there's that rental yield that you can get, but I think you'll find, at least in the initial stages, a lot of that rental yield goes to helping you pay the loan that you've subsequently taken out to fund that investment. And I guess rent isn't guaranteed as well. You can have periods of non-tenancy in terms of impacting the ongoing income you could receive. But you also receive ongoing income from other investments. So in this scenario, you would receive dividends from your shares or distributions from your managed funds. So there is an aspect of ongoing income to other investments other than just property. The other thing that's quite big is the drawdown requirements that you might have in the future. So one limitation of a property is that it's a very lumpy asset. So if you want to, I guess, partially redeem from it, you can't exactly choose a room and say, I want to sell that room to get a bit of cash to do, like, for instance, to purchase a car or something that you need. But when you have an investment portfolio, you are able to partially redeem without impacting that whole asset as a whole. So again, it's just a little bit more flexible. The other thing is, obviously, you can make ongoing contributions to an investment portfolio and keep propping that up, reinvesting distributions to, I guess, get the benefit of compounding interest and earnings in that environment. And lastly, probably most importantly, is your exit strategy for an investment. So in order to redeem a property, you need to find a buyer. And I guess sometimes it's not that easy because you need to find a buyer who wants to buy your property, who can buy it, and then wants to pay the right price for it. So selling a property, I guess, leaves you with a buyer that isn't so broad in terms of the buyer market. But when you have a listed investment, at least, there's hundreds of people buying and selling every day, and you have buyers who are national or international. The scope is much broader. So I guess there's not as much lag time around if you need to exit an investment. You've got a little bit more options up your sleeve there. So in essence, I guess I'd encourage young people to think of other investment options available to them, and then find out what financially suits them, and then make an educated financial decision around what's best for you.
Brilliant. Thanks, Lauren. So that now brings us to the end of this webinar today. We'll be back next week for part 2 of the series. Next week, we'll look at the stock market, becoming a day trader, personal insurance, starting a family, preparing a will, and taking the first steps in planning your retirement. Audience members, thank you very much for your time today, and we'll see you next week. Thanks again, Lauren.
Thanks, Richard. Take care.
Thanks.